In this video, I'm going to go through some of the details for one of the funds I'm raising capital for. So if you haven't seen my other videos, this is not, this is what I feel comfortable sharing publicly. So these are just going to be numbers. This could be anonymized. I'm not going to share names. You're not going to see the executive summary or anything like that. So this is meant to be in partnership with that information. So if you're interested in seeing the executive summary, seeing the legal documents, seeing the operating agreements, then you can reach out to me and I'll share that with you privately. But so the objective here, this is going to be tactical, is I'm going to go through the numbers of what the projection is for the fund, and I'm going to benchmark that against the S&P. So here we go. Okay, so I'm not going to spend a lot of time on this sheet, but for me, it's important to do this stuff for myself because I'm investing in these funds. So the first thing, the challenge, if you haven't seen my other videos, is okay, what's the S&P going to do? So nobody knows, nobody can predict that. Otherwise, that person would be infinitely wealthy. So Goldman Sachs had a pretty good report where their prediction over the last 10 years is a range of 2 to 11%. They predict the large cap index, which is similar to the S&P, will deliver 6% over the next 10 years. Historically, over the last previous 10 years, it's delivered about 14%. Like I've talked about a lot, like I'm sure you've heard a lot. That was due to the inflationary environment. We've been in a bull market for 14 years, low federal funds rate, a lot of quantitative easing. So most predictions are a lower return over the next 10 years. Over the past 140 years, U.S. stocks average about 9.2%. This next, and I'll just skip down to Charles Schwab, similar prediction for the same time period, about 6%. And this one here, this was just looking at a little sooner time periods where Jim Cramer, Tom Lee expect these values for the S&P. So both would mean a price drop. So just the takeaway there is what this is doing is calculating for $100,000 investment that what I would have in the S&P in 2030. So this fund is 7 to 10 years. I mapped out 7 years, and I made some estimates here. So I took Jim Cramer's actually, sorry, I took the bull. I took Tom Lee's estimate of the S&P, so that means a little bit of a drop. And then I just conservatively did 6% year over year. So if you're interested in this fund and you're either bearish or so bearish meaning worse, and you want to do something like this, like, oh man, I think the S&P is not going to look real well, or if you're bullish and you're like, no, I think the S&P is going to rip. We can go through these things, and this is kind of set up to be able to compensate for that. So you can see how this return would look under different scenarios. So let me go through some terms real quick. I guess firstly, so S&P is estimating by 2030, I'd have about 140K. So I'd gain about 40K. So the first thing I want to go through are a couple terms in case you haven't seen my other videos. So the first one is called a preferred return. So what this means is this is saying, let's say that, this fund's rate of return projected is 15%. This is saying that the general partners get nothing up until 7%. So that means that if this fund tanks and does really bad and is only returning 6%, that means that the general partners are working for free, right? So something would have to go catastrophically wrong to not get 7%, right? If you're working with an idiot, that's a different story. If you're working with an experienced investor that does this full time, right, and this is their life, they do not want to work for free, right? So the pref, if you trust the operator and they don't die or something crazy, is basically guaranteed. These are like black swan events to not get the pref with low risk funds. Okay, for something else, venture capital or something, or if you're investing in like volatile assets, that's different, right? But for this particular fund, which is a non-levered investment in single family homes in the Midwest, this is, to me, I look at this is basically guaranteed 7%. Something would have to go horrendously wrong. So then the next thing is return of capital. So this specific deal is 25-75 split after the pref up to 50% IRR than 50%. So what that means is after 7% to 15%, the limited partners get 75% of the capital, right? The GPs get 25%. Okay. After, and then after 15% IRR, it gets better for the GP. So this is them basically saying, if we give you what we say we're going to give you, then we want to make more money, right? So that's kind of how this works. It's typically a waterfall here. So the GPs obviously want to hit this, right? They want to hit 20% because that additional 5%, they're making 50% of that. So that's how those guys get rich, is when they hit these baseline milestones. And then the projection here is 19% cash on cash. So the difference here is this is assuming a sale of these assets in the end, right? And a sale of the assets could mean an outside buyer, or it could mean the GPs just buy this back if it's a great deal, so that they can continue making all of the cash flow, right? So it could be either of those scenarios. So let me talk to a couple things here. So this one is pretty simple. It's just saying you're going to get 9% cash on cash, right? And this is going to be based on the cash flow of the single family homes that they make every month. So the projection is you'll get on a $100,000 investment every quarter, you'll get $2,250. So if you're not in funds right now, this is really nice. You know, it is really nice seeing this. It's a much lower anxiety thing than being in public volatile assets, even like the S&P. You know, the S&P is supposed to be relatively stable relative to if you're going to pick stocks or do small index stock, small stock indices or something like that. But it can be anxiety inducing, right? Because you hear things, you're like, oh, what's going to happen? You see it going up and down. You see your net worth going up and down. So receiving consistent distributions every month is really nice, right? So this is a significant chunk of change. You can then go reinvest in whatever you want. So that's all I'm going to cover here. This is basically saying you're going to make about $60K just in distribution. So just in cash, you are getting, this is projecting more than $20K over the S&P and equity, which makes sense, right? Because we're estimating 6% versus 9%. So that's all I'm going to cover here. And then I have a couple graphs for this deal. Just give me a second. All right. Okay. So this first one, this is showing the total value that you have. Okay. This is going to be the equity plus your running distributions to paid in capital. So that's the money you're getting back versus your equity interest in this asset, which is a collection of houses that are cash flowing houses. So this is your total value split relative to the S&P. So the first thing you'll see here is that you can see your equity. So this equates to the appreciation of the houses, right? So you can see that that's actually appreciating, and it seems to be correlated to the S&P. This is just happenstance. Okay, I want to make sure I'm specific about that I'm not saying the housing price index should be correlated to the S&P. This is just happenstance. You know, I used that information to predict a 6%. Historically, the housing price index has underperformed the S&P. Historically, the S&P has done a lot better. So I'll show you two charts here. So, you know, here's about 40 years of data. So this is basically showing you how these two different indices have performed. So you can see that the S&P has significantly outperformed the housing price index. I don't like this chart a ton. The reason for that is because once you start to get in 2008, where you see this big divergence, there's so much QE in such a low Fed funds rate that this kind of, I don't know, not super valuable. So I wanted to look at this one as well. So this is from Fred St. Louis. This is the percent change in those indices. So you can see the S&P is pretty volatile, right? This is on a monthly basis. So almost every month it's either up or down, whereas the housing price index is sort of consistently growing, right? And I know this looks like they're about on par, but it's not, because what you'd have to do here is take the area under the curve, basically, and you would get this same disparity here. But you can see, generally the housing price index has just year over year increased by about 3%. And then you can see, up here in 2022, this is the first time, well, not the first time, but one of the few times that the housing price index actually did increase more than the S&P. But I just wanted to be fair there, because I'm obviously bullish on real estate, meaning I'm optimistic about real estate. But I wanted to be fair that this was just happenstance, that I'm not saying that house prices are always going to be correlated to S&P. They're not. They're actually significantly different. So that was just this analysis. But the last thing what we'll see here is, so your total value is mostly equity, right? And then you're receiving those consistent cash flow distributions. And then right at the end, this is predicting a sale, where you see, and then this is predicting you'll make about 205K versus 142 in S&P over 7 years. So this is just showing that a little bit more. So this is your total value. So this is your equity appreciating at their rate. So they estimated about 5.5%. And again, this is historical averages. These are Midwest properties. So, this guy, this operator's been doing this for 20 years. So this isn't, just throwing darts at a dartboard. This is taking a look at over 1,000 properties that have been flipped, and, 20 years of data, and saying, okay, what do I think this appreciation is going to be? And this is also, all of these analyses are conservative, right? So I'm showing conservative estimates here. And again, like I said before, the reason for that, right, is these GPs want to make a lot of money. So when you see things like, 7% pref and, 25-75 split up until 15%, that's not what they want, right? They want 20-25%, because that's where they get rich, right? Where you're getting, if the total deal is 25% IRR, that means from 15% to 25%, that's where they're making 50% of the profit. Anything before that is 25. Okay, so this is estimating equity is going to grow at about 7%. Okay, and then the last thing here is just reflecting that at the end, this is expecting a sale where all the capital plus your initial contribution will be paid back. So here's the last thing, if you haven't seen my other graph. So what I do here is I want to be clear about why distributions to paid-in capital are massively better than equity gain, right? So you see this graph here, you're like, oh, okay, this is, better. This is great. You see these numbers are better. But when you receive distributions quarterly versus watching a ticker online that's just going up or down, you can reinvest those distributions. So what this is showing you is that every quarter, when you get distributions back, if you reinvest that into the S&P, you are now making $220,000 versus the S&P 142. So you're making another 205. Now, what I want to call out here, though, is that the people that do this full time, the guys I invest with, the guys where, here you're making about $2,000 a quarter, they're making over 100x that, right? They're basically making, someone's annual salary every quarter and reinvesting that. They're not receiving these distributions and investing in the S&P, right? They're investing in other funds. So if you believe this to be true, and this has been my experience has been, this is a conservative estimate, right? It a lot of times is a lot better than this, like I talked about, because the pref stacks and the waterfalls in a lot of these funds are conservative estimates. If you think about, like, wow, what if this was a lot better, and you're redistributing that capital into those deals, that's how you create generational wealth, guys. That's how you break out of the rat race. That's how you retire when you're 40. So anyways, in the last thing I want to cover, in case you didn't see the other videos, if you are still not sure about whether you should go into a private asset like this or a public asset, in case you're bullish on something, like if you're bullish on crypto, you're like, oh, crypto's going to come back. Or if you're like, oh man, freaking Nvidia, they're going to have a monopoly on chips for AI, so they're going to rip. Or Mark Zuckerberg, whenever he beats Elon Musk in the cage, like Facebook's going to rip. What this allows you to do is hedge those scenarios, right? So if you're bullish on something else, every time you get distributions, you can invest in that thing, right? So that if you're right, you still get to participate in that upside in a significant way, because these are, if you take a look after 2 years, you've got about, or sorry, 3 years, you've got about 30K back, right? Of your initial 100K. So it allows you to hedge so that if you're right, you can participate in that upside. But what it really allows you to do here is if you're wrong, if there's something else you want to invest in, if you're wrong, you're still okay, right? You have a stable, low risk asset where you're not going to lose everything in that volatile asset. So let me shut this down. So anyways, I hope that was helpful. This is what I felt comfortable sharing publicly, and it's the analysis I do, right? I'm not a general partner. I'm a limited partner. I'm investing in all these deals alongside everyone else. This is how I'm growing my retirement account and whatever. So this is the analysis I do when I think about how this is going to look, and I run through the scenarios like, what if this happens and this happens? So if you want more information on this specific deal, which is a pool of single family homes a pool of single family homes that are both long-term rentals and short-term rentals, vacation rentals, then you can reach out and I'll give you the executive summary and the operating agreement and things like that. It is July of 2023. So for the next couple months, we will continue to raise capital for this deal. This one specifically will probably go for another year or two. The reason for that is if we max out on this, which we might, then there's going to be another capital raise for basically another portfolio of homes that come into this fund, and it's homes owned by the operator. So this is one of the things he does is funds. The other thing he does is he has his own pretty massive portfolio of homes, but he's just looking to diversify out of that into some other things. That's why he's kind of launching these funds to raise capital for is a low risk place to put your money. So if you're interested in that, you can reach out and I'll give you the details. And then again, if you want to play around with some of the numbers, we can hop on a call, or I can just send you the sheet and you can plug in your own percentages and see what it looks like. I hope this is valuable to you. Like I said, if you have any questions, feel free to reach out.